Hey, before we get into today's topic, I want to tell you something that genuinely shocked me when I first learned about it. Imagine this: you are a business owner, you are running a company for a year, things feel fine, sales are coming in, and you are paying your bills. Life feels good, and then your accountant calls you.
Hello sir, there's a $23,000 error sitting in your books.
Not fraud, not theft, not even bad business decision. Just one tiny journal entry posted to the wrong account back in February. That one error sat in your accounts quietly for 5 months. No, it will take 3 weeks to investigate, few thousands as a professional fees, and a whole lot of stress to fix. And here's the part that kills me about that story. It was completely preventable. There's a one tool, literally one, that accountants have been using for hundreds of years that would have caught that mistake under 5 minutes. And that tool is called trial balance. And by the end of this video, I promise you are going to understand what a trial balance is, how to build one, and what errors it can and cannot catch. So, first question that comes into the mind is what is a trial balance? Trial balance is a report that lists every single account in your journal ledger, your cash account, your revenue account, your expense account, your loans, everything, and its current balance. Then each balance is either placed on debit side or credit side depending on its type. Then both columns are totaled at the bottom. There's a rule in accounting, and that rule is non negotiable. If your books are correct, then your total of debits will be equal to the total of all credits. Always, no exception. Why it must always balance? Now, you might be wondering why does it always have to balance? Why must debit always equal credits? Well, the answer goes back to something called double entry accounting. And if you have not heard it about yet, it is basically backbone of all modern bookkeeping. And here's how it works. Every single transaction you record has two sides, a debit side and a credit side. And they always have to be equal. For example, a client pays you $3,000. You debit your cash account because cash is coming in, and credit your revenue account because you have earned it. 3,000 in, 3,000 recorded, both sides are equal. On the other hand, you pay 800 to your staff in wages. You debit your wage expense account because your wage expense account went up, and credit your cash account because your cash account went out. 800 out, 800 recorded, both sides are equal. This comes directly from the accounting equation. Assets are equal to the liabilities plus equity, and every transaction you record keep this equation in balance. Now, after recording hundreds or even thousand transactions, all of your debit entries must equal to the all of your credit entries. This is not a coincidence. This is the mathematical certainty. If you have recorded everything correctly. And trial balance is how you verify that certainty. You pull all the balances together, add them up, and check. Alright, let me show you exactly how to build a trial balance from scratch. We are going to use a company called Bright Ideas Limited, a small consulting firm in its second month of operations. Here's what happened this month. This business had 6 transactions during the month, a pretty normal month for a small business. We will use these 6 transactions to build our trial balance in 4 simple steps. The transactions are shown on your screen. Let's start with step 1. Step 1. Record every business transaction as a journal entry. This is the first step in the accounting cycle and the foundation of accurate bookkeeping. Every journal entry follows one simple rule. For every debit, there must be an equal credit. In other words, the total amount debited must always equal to the total amount credited. This is what keeps the accounting equation in balance. Take a look at the journal entries on your screen. Each transaction records which accounts are affected, whether these should be debited or credited, and the exact amount involved. For example, when the business earned consulting revenue in cash, cash is debited and the consulting revenue is credited for the same amount. Likewise, when the business pays wages, wages expense is debited and cash is credited. Once every transaction has been recorded correctly, we are ready to move to the next step, posting these journal entries to the journal ledger. Step 2. Post every journal entry to the journal ledger. In simple terms, this means transferring each debit and credit from the journal into its respective account. As you do this, each account keeps a running balance, making it easy to see how every transaction affects it over time. Let's walk through the cash account as an example. As you can see on the screen, we start with an opening balance of $15,800. During the month, cash increases from consulting revenue and advance payments received from customers. At the same time, cash decreases because of wages, rent, equipment purchases, and utility payments. After adding all the debits and subtracting the credits, the cash accounts end with the debit balance of $17,300. You will repeat this exact process for every account in the ledger. By the end, each account will have one final balance, either a debit balance or a credit balance. And those balances are what we will use in the next step to prepare the trial balance. Step 3. List every account along with its ending balance. Place all debit balances in the left column and all the credit balances in the right column. A simple rule makes this much easier to remember. Assets and expenses normally carry debit balances, while liabilities, owners, equity, and revenue normally carry credit balances. Following this rule helps ensure each account is recorded in the correct column. Step 4. Now it's time for the final check. Add up the debit column and the credit column. Then compare the two totals. If they match exactly, your trial balance is balanced. As you can see on the screen, every account has been listed with its final balance in either the debit side or the credit side. When we total everything up, the debits equal $29,800 and the credit also equal $29,800. That's exactly what we want to see. A balanced trial balance tells us that mathematically every debit has been matched by an equal credit. It's an important checkpoint that helps us confirm our ledger has been recorded correctly before we prepare the financial statements. Keep in mind, though, a balanced trial balance does not guarantee that every transaction is error free. It simply means the books are in balance. In our example, the trial balance passes successfully, so we are ready to move on the next stage of the accounting cycle. Now, here's a question I get asked most often. What types of error our trial balance actually catch? Great question. Our trial balance catch those errors which creates mathematical imbalance between total of debits and total of credits. There are four main types. Error number one, recording only one side of a transaction. Imagine you record a debit of $500, but you forget the credit. Now, your total debits are 500 more than your total credits. Trial balance fails immediately. Error number 2, recording unequal amounts. You debit $1,000 but accidentally credit 100. One extra zero is missing, and your trial balance is $900 out of balance. Error number 3, transposition error. This is a sneaky one. This error happens when you accidentally swap two digits. You meant to type 820, but you accidentally enter the amount 280. If this happens on the one side of trial balance, your trial balance will be out of balance. Error number 4, posting to the wrong side. If you record a debit as a credit, your trial balance will be off by the double amount. If the entry was $500, your trial balance will be out of balance by $1,000. Errors the trial balance does not catch. No, this is the part that surprises most people. And this is where a lot of business owner gets a false sense of security. A balanced trial balance does not mean your books are free from errors. It only means your books are mathematically correct. There are several types of error which trial balance cannot detect. And let me show you four of them. Error number 1, wrong account, correct amount. Imagine you pay $500 for office supplies expense, but accidentally debit office equipment instead of office supplies. The total debit is still $500 and your trial balance is still balance, but your financial statements are now wrong. Equipment is overstated and office supplies is understated. And the thing is, your trial balance has no idea. Error number 2, completely omitted transactions. Imagine you forget to record a complete transactions. Both sides are missing. Your trial balance has no idea. It stays balanced, but your records are incomplete because an entire transaction just does not exist in your accounts. Error number 3, duplicate entries. If you record a transaction twice, your debit and credit are equally doubled, and your trial balance stays balanced because both sides are wrong. Error number 4, compensating errors. Two separate errors that are equal but opposite. They cancel each other out, but your trial balance still passes, and the two errors hiding inside your records. This is why trial balance is a necessary check, but not sufficient one. It is the first line of defense, not only line of defense. You still need a human being to review the entries for logic, classification, and completeness. Trial balance tells you maths add up, but it does not tell you math makes sense. Okay, practical question. How often should you actually be running a trial balance? The minimum is once per accounting period, typically once a month. after you post all your journal entries and before preparing your financial statements. But honestly, running a trial balance at the end of the month is not enough. Here's what I recommend: run a trial balance every single week. I know that sounds like a lot, but in accounting software like QuickBooks, Wave Zero, it takes less than 5 minutes to run a trial balance. You literally click a button. And here's why it matters so much. If your trial balance is out of balance at the end of the week, you might have 15 or 20 transactions to review. And if your trial balance is out of balance after a month, you might have 70 or 80 transactions to review. Same error, 4 times harder to find. And if you run a trial balance at the year end, you might be searching that error under thousands of entries. That's days or weeks of detective work. The single simplest financial habit a business owner can build is to take 5 minutes every single week, run your trial balance, and check that it balances. One more thing before we wrap up, and this tripped me out when I was first learning accounting. So I want to make sure it's clear for you. In accounting cycle, you don't just prepare one type of trial balance. You actually prepare three types of trial balance. Think of them as a three-step verification system. Each one serves a different purpose, but together they keep your book clean at every major checkpoint. Number 1. The unadjusted trial balance. This is prepared before you make any adjusting entries. It is your raw check. Does everything is balanced based on the original transactions you recorded? Number 2. The adjusted trial balance. This is prepared after you post all your adjusting entries. Things like prepaid expense being used up, accrued income you have earned but not invoiced yet, and depreciation on asset. This is the version that reflects complete and corrected picture for the period. And this is the one you use to prepare your financial statements. Number 3. The post-closing trial balance. This is prepared after you close your temporary accounts like expenses, revenue at the end of the period. It confirms that only permanent accounts remains with their balances. And it also ensures that your books are clean for the next period. If this video helped you understand trial balance, hit that like button. It really helps more people to find this video who need to learn this too. And if you have not subscribed yet, join us. We are building complete accounting learning library here on Debit Decoded, one topic at a time, explained in a simple way with real example and no confusing terms. Next week, we are covering financial statements, what they actually are, why business needs them, and how to build one step by step from scratch. This is one of the most important videos on the whole series, so you really don't want to miss it. And if you have not watched our accounting cycle video, link is in the description below. That is the best video to start. And tell me in comments, did this video help you understand something better, or is there another topic you want to cover next? I read every comment, and your questions really do shape what I make next. See you in the next video.